Ladies and gentlemen, global investors, pay close attention. When silver begins to outperform gold, history shows the market is not whispering, it is warning. This is not noise, not speculation, and not a coincidence. It is a signal that has repeatedly appeared before periods of deep financial stress, structural shifts, and moments when confidence in the system itself begins to fracture. For decades, gold has been treated as the ultimate monetary metal, the final anchor of trust when currencies weaken and uncertainty rises. Silver, by contrast, has always lived in two worlds at once. It is money, yes, but it is also an industrial lifeline embedded in electronics, energy systems, medical technology, and global manufacturing. When silver starts leading gold, it tells us something critical. The pressure is no longer confined to fear alone. It is moving into the real economy. The gold-silver ratio is one of the oldest market indicators still in use. For centuries, it has acted as a barometer of stress, growth, and imbalance. When the ratio rises sharply, gold is outperforming silver, signaling fear, deflationary pressure, or a rush towards safety. But when the ratio falls, especially rapidly, it means silver is gaining ground. Historically, that shift has occurred when inflation expectations are changing, industrial demand is tightening supply, or monetary credibility is being quietly questioned. This matters because silver is far smaller than gold in market size, far thinner in liquidity, and far more sensitive to physical demand. Roughly half of all silver consumption comes from industrial use. That includes solar panels, electric vehicles, data centers, military applications, and critical infrastructure. These are not optional sectors. They are strategic and, in many cases, non-negotiable for governments and corporations alike. When silver prices rise relative to gold, it often reflects stress inside these supply chains long before headlines acknowledge it. Over the past several decades, every major compression in the gold-silver ratio has coincided with a broader macro shift. In the late 1970s, silver surged as inflation accelerated and confidence in fiat currencies eroded. In the early 2000s, silver began to outperform as global growth expanded, industrial demand climbed, and debt levels quietly ballooned. Following the 2008 financial crisis, silver again outpaced gold as central banks flooded the system with liquidity, distorting price discovery, and pushing investors toward tangible assets. Today's environment carries echoes of all three periods, but with greater complexity and far higher stakes. Global debt has reached levels never before seen in peacetime. Monetary policy has oscillated between extreme tightening and emergency easing, eroding predictability. Supply chains remain fragile, geopolitical tensions are persistent, and industrial metals are increasingly treated as strategic resources rather than commodities. In this context, silver's behavior becomes impossible to ignore. When silver starts to rise faster than gold, it suggests that inflation expectations are not fully contained, even when official data claims otherwise. It suggests that industrial demand is colliding with constrained supply. Unlike gold, silver is consumed. It is not simply stored and retrieved. Once used in industrial processes, much of it is gone, dispersed, or uneconomical to recycle. That structural reality creates pressure that paper markets struggle to suppress indefinitely. This brings us to a critical distinction most investors overlook: the difference between paper markets and physical markets. In futures exchanges and derivative products, silver can be created in virtually unlimited quantities. Contracts can be written, rolled over, and settled without any metal changing hands. But physical silver is finite. It must be mined, refined, transported, and delivered. When demand rises in the physical market and supply fails to respond quickly, price signals eventually break through the paper narrative. When silver leads gold, it often indicates that physical demand is asserting itself. It means industrial users are securing supply regardless of price. It means investors are looking beyond monetary hedges and toward assets tied directly to real-world function. It also means the margin for error in the financial system is narrowing. Gold tends to react to fear. Silver reacts to stress. Fear can come and go. Stress accumulates. Stress builds quietly in debt markets, in energy grids, in manufacturing inputs, and in government balance sheets. Silver feels that stress early because it sits at the intersection of money and necessity. This is why the signal carries such weight. A falling gold-silver ratio is not simply about relative prices. It is about a shift in underlying pressure. It reflects a world where liquidity injections no longer resolve structural problems, where rate hikes fail to restore stability, and where growth depends increasingly on materials that are harder to source and harder to substitute. Globally, the implications are profound. Emerging markets depend heavily on silver-intensive technologies to expand energy capacity and digital infrastructure. Developed economies rely on silver to maintain aging systems and transition toward electrification. At the same time, mining supply has struggled to keep pace, constrained by declining ore grades, rising costs, and years of underinvestment. This imbalance does not announce itself loudly, but it does leave a trace in the ratio. When silver begins to lead gold, markets are not predicting a single event. They are reflecting a broader condition, mounting pressure beneath the surface of the global economy. A condition where traditional safe havens are no longer enough on their own, and where the boundary between financial stability and physical reality grows thinner by the day. This is not about optimism or pessimism. It is about awareness. The gold-silver ratio has never been a perfect tool, but it has been a remarkably honest one. It does not respond to speeches or promises. It responds to demand, scarcity, and stress. And when it starts to move decisively, it deserves attention. Not because it guarantees an outcome, but because it reveals a change in the environment that shaped every major market cycle before it. What the market is signaling now is subtle, but unmistakable to those who know how to read it. Silver is not leading by accident. It is leading because the world is changing, pressures are aligning, and the margin for complacency is shrinking. The warning is not dramatic. It is disciplined, mathematical, and rooted in reality. And historically, those are the warnings that matter most. What makes this moment particularly important is that the signal is forming in a global environment that is already under strain from multiple directions at once. Monetary systems are stretched, fiscal discipline is eroding, and trust in long-term stability is being tested not by a single shock, but by a sequence of unresolved pressures. In such conditions, markets tend to reveal truths indirectly, through relationships rather than headlines. The relationship between silver and gold is one of those truths. Central banks around the world have spent more than a decade reshaping market behavior through intervention. Interest rates were pushed to historic lows, balance sheets expanded beyond precedent, and asset prices were supported to maintain confidence. These policies succeeded in delaying pain, but they also distorted price signals. When money becomes abundant, the difference between value and price grows harder to detect. Gold responded as expected, absorbing monetary fear. But silver, constrained by industrial reality, began responding to something deeper. Inflation, in its truest sense, is not simply rising consumer prices. It is a loss of purchasing power, a dilution of currency credibility. Even when headline inflation moderates, the structural forces behind it often remain intact. Energy systems require constant investment. Infrastructure demands maintenance. Technology requires metals that cannot be printed. Silver sits at the center of this equation. As currencies expand and real-world inputs remain finite, tension builds. This tension becomes visible when industrial users step into the market not as speculators, but as necessity-driven buyers. Solar manufacturers do not wait for perfect pricing conditions. Defense contractors do not pause procurement cycles. Medical technology does not substitute away from silver easily. When demand from these sectors rises, it does not negotiate. It secures supply. This is why silver reacts differently than gold. Gold reflects confidence in money. Silver reflects confidence in systems. Historically, when silver begins to outperform gold, it has often preceded periods where policymakers lose control of the narrative. In such moments, markets stop reacting to guidance and start responding to constraints. The late stages of economic cycles tend to expose these constraints brutally. Debt levels limit fiscal responses. Higher interest rates strain governments and corporations simultaneously. Currency volatility complicates trade. In this environment, assets tied directly to physical utility gain relevance. The paper market, however, attempts to smooth these signals. Futures contracts, options, and exchange-traded products create the illusion of depth and flexibility. But these instruments rely on confidence that settlement can always be deferred, rolled, or netted out. When stress increases, that confidence weakens. Physical delivery becomes more important. Inventory levels matter. Backwardation appears. Premiums widen quietly before they are acknowledged publicly. Silver has a long history of exposing this disconnect. Because the market is relatively small, large shifts in physical demand can overwhelm synthetic supply. When this happens, price movements appear sudden and disproportionate. Observers often label them as speculative or irrational. In reality, they are the delayed recognition of pressures that built slowly beneath the surface. Globally, governments are facing a difficult trade-off. Maintaining growth requires continued spending and accommodation. Restoring stability requires restraint. Attempting both simultaneously erodes credibility. This erosion does not immediately collapse currencies, but it does change behavior. Investors diversify. Corporations hedge. Institutions seek assets that function regardless of policy direction. Silver benefits from this shift not because it is fashionable, but because it is functional. There is also a geopolitical dimension that cannot be ignored. Supply chains for critical materials are increasingly politicized. Export controls, sanctions, and strategic stockpiling are no longer theoretical risks. They are active tools of statecraft. Silver production is geographically concentrated, often as a byproduct of other mining operations. This limits the industry's ability to respond quickly to rising demand. New supply requires time, capital, and stability, conditions that are not abundant. As these constraints tighten, the gold-silver ratio responds. It compresses not because gold is failing, but because silver is being pulled upward by forces gold does not face. Gold can be stored indefinitely. Silver is consumed. Gold reacts to monetary fear. Silver reacts to economic necessity. When necessity begins to dominate, markets adjust accordingly. This adjustment is rarely smooth. It often occurs alongside volatility, conflicting data, and official reassurance. Policymakers emphasize control. Markets test boundaries. In this gap, signals like silver's relative strength become increasingly valuable. They operate independently of rhetoric. They are not influenced by optimism or denial. They reflect transactions, not intentions. For global investors, this is where attention should sharpen. Not toward predictions of collapse or exuberant rallies, but toward understanding why relationships are changing. When silver leads gold, it suggests that stress is migrating from abstract financial constructs into tangible systems. It suggests that inflationary pressure is not merely a statistical artifact, but a lived reality within production chains. It suggests that the margin between supply and demand is narrowing. This does not mean the outcome is predetermined. Markets are adaptive. Policy can still influence trajectories. Innovation can alter demand patterns. But adaptation under pressure carries costs. Those costs tend to surface first where flexibility is lowest. Silver, bound by physical limits and industrial reliance, has little room for illusion. What the ratio is expressing now is a subtle warning that the global economy is leaning more heavily on real resources at a time when access to those resources is becoming more constrained. This imbalance does not resolve itself quickly. It evolves, tests systems, and forces repricing across multiple layers of the market. And as it does, the signals grow clearer, not louder, but more consistent. Silver's leadership in this relationship is not a headline event. It is a background process, unfolding quietly, measurable only to those watching closely. But history suggests that when this process accelerates, it rarely does so in isolation. It reflects a convergence of monetary pressure, industrial demand, and structural fragility that reshapes expectations long before it reshapes consensus. In that sense, the market is not issuing a warning about silver or gold specifically. It is signaling something broader about the environment they operate within. An environment where stability is increasingly manufactured, where resilience is tested by reality, and where the difference between financial abstraction and physical necessity becomes impossible to ignore. As this environment continues to evolve, the significance of silver leading gold becomes less about short-term movement and more about what it reveals beneath the surface of the global system. Markets, at their core, are not emotional. They are adaptive mechanisms, constantly adjusting to constraints, incentives, and limits. When a long-standing relationship like the gold-silver dynamic begins to shift, it is rarely reacting to a single data point. It is responding to accumulated pressure. One of the most important pressures today is the narrowing space between policy intent and economic reality. Governments can set targets, central banks can issue guidance, but they cannot command geology, physics, or industrial necessity. Electrification, digitization, and energy transition are not abstract concepts. They require materials, they require throughput. They require metals that exist in finite quantities and are increasingly difficult to extract cheaply. Silver is woven into this transformation more deeply than most realize. At the same time, financial systems remain heavily leveraged. Debt, both public and private, has grown faster than productive capacity. This creates fragility. It limits how far interest rates can rise without destabilizing borrowers. It constrains fiscal flexibility. It also increases reliance on continued liquidity support. These conditions favor assets that sit outside purely financial promises, yet still integrate into the real economy. Silver occupies that space with uncomfortable clarity. Gold continues to play its role as a store of monetary confidence. It reflects doubt in currencies and protection against systemic shock. But silver goes further. It reflects strain inside the machine itself. When factories compete for supply, when energy infrastructure expands faster than material availability, when technological progress collides with physical bottlenecks, silver responds. Its price behavior captures this collision in real time. This is why the warning embedded in silver's leadership is often misunderstood. It is not a prediction of crisis on a specific date. It is not a guarantee of dramatic repricing tomorrow. It is an indication that the system is operating closer to its limits than official narratives suggest. It implies reduced slack, lower tolerance for disruption, and higher sensitivity to shocks. History reinforces this interpretation. Periods when silver sustained outperformance over gold have tended to coincide with transitions rather than endpoints. Transitions from stability to volatility, from confidence to questioning, from abundance to constraint. These moments are rarely comfortable, but they are formative. They reshape assumptions about risk, value, and resilience. In a globalized economy, these shifts do not remain localized. A tightening in industrial metals affects manufacturing costs worldwide. Currency weakness in one region transmits inflation elsewhere. Supply disruptions cascade through interconnected systems. Silver's signal reflects this interdependence. It is global by nature because the forces acting upon it are global in scope. What makes this signal particularly valuable is its lack of narrative bias. Silver does not respond to optimism, reassurance, or denial. It responds to orders placed, contracts fulfilled, inventories drawn down. It reflects decisions made under necessity, not confidence expressed in words. In an age saturated with commentary, such signals are rare. This does not mean the future is predetermined. Systems adapt, substitution occurs. Efficiency improves, but adaptation under constraint is costly, and those costs must be absorbed somewhere. Markets absorb them through repricing. Relationships shift, ratios move. Signals emerge. When silver leads gold, the market is not calling for panic. It is calling for awareness. It is asking observers to look beyond surface stability and consider underlying pressures. It is reminding participants that monetary systems rest on physical foundations, and those foundations are under increasing demand. For global investors, policymakers, and institutions alike, the lesson is not to react impulsively, but to observe carefully. To recognize that stability maintained through intervention is not the same as resilience built through balance. To understand that when industrial necessity begins to dominate monetary fear, priorities are changing. The gold-silver ratio has endured for centuries because it captures this balance elegantly. It compresses complex realities into a simple relationship. When that relationship shifts meaningfully, it deserves respect, not because it predicts, but because it reveals. What is being revealed now is a world leaning harder on tangible resources while carrying unprecedented financial weight. A world where efficiency gains struggle to offset rising demand. A world where confidence is managed but pressure is real. In such a world, signals become more important than stories. Silver's leadership is one of those signals. Quiet, persistent, and grounded in function rather than faith. It does not announce itself with certainty, but it does leave a trail. And for those willing to follow that trail, it offers insight into where stress is building, where assumptions may fail, and where the margin for error is thinner than it appears. This is why the market's message matters, not because it demands action, but because it invites understanding. When silver leads gold, the market is reminding us that beneath every financial system lies a physical reality, and that reality, sooner or later, always asserts itself.